I've been working towards this video over the past 5 months, and now it is finally ready. Let's dive into it. I hope you will enjoy it, get some value out of it, because I certainly have, and thank you so much for being here.
This is the Bible of high inflationary times, and I would recommend anyone who is young to read it and to study it and not put it aside, but to read it again every year to remind him about the evil of central banks. They are thieves. They are abusing the system, and they work for the rich people and against the masses. The average person suffers under monetary inflation, whereas people with assets like me who are beneficiaries. Do you understand? I do not complain. I complain as an economist, but as an investor, of course, money printing is good. And you have to ask yourself always the question, do I provide something positive for society or not? Or in a company, I am useful to the company or I'm just a cost? Because if you're the cost, you're going to lose your job one day because the company will cut costs. But the guy who brings in money, say he acquires new clients and he covers the clients and the company gets income, commission income or fee income, such a person is useful. So these are things I would think when I'm young. And I did think about it. I mean, I always looked that I was profitable for the company I worked for. And then I started my own business. But I didn't start my business right away. First, I worked for 2 companies, American investment banks, for 20 years altogether, 1970 to 1990. Then I started my business because you need some experience, and it's easier to start a business if you know how to make money, where the money is, because the client, he doesn't see where the company makes the money.
And the number of investments you should own, and I tell young people this now, is take your age, deduct the number 20, and that's how many investments you should own. So if you're 21, you're fine owning 1 investment, all in. If you're 22, now you should have 2. If you're 60, you should have 40 investments, because the older you get, the less time you have ahead of you to recover things, and therefore you need to be much more diversified, so that if one of your conviction bets goes wrong, you still have all the others.
The first wealth you build is internal. Educate yourself. Find a way, a profession, a vocation, a job, a business, where you add more value than you consume. You make money by generating utility for other people, where the product, the good, the service that you provide is worth more to them than the unit of their savings that they have to spend to acquire it. So the first thing you do is you educate yourself and you become equipped to provide a valuable service or good. You might do it working for somebody else. That's a perfectly good way. I did that for a long time. You might do it for yourself. It might be that you have to form your own business because your employer, you believe, is victimizing your customer, and you have to leave that platform. Once you've done that, the second thing that you have to do is live well within your means. You can't become rich on your own production alone. You have to become a capitalist. And to be a capitalist, you have to have capital. A lot of people forget this. Maybe most people I talk to, when it comes down to it, don't want to be rich. They want to live rich. And those people will never succeed, or if they do succeed, it will be by accident. You have to save a minimum of 10% of your income pre-tax. There was a point in time in my life when my wife and I were saving 50% pre-tax. But you must save. You absolutely, positively must save. And then once you save, you need to be able to both invest and, if you have the stomach for it, speculate rationally. Those are the steps. If you do that in any circumstance, you will do well. And you have to maintain a positive outlook. I would suggest that one prerequisite is to read a book called Economics in One Lesson by Hazlitt, a book that teaches you the way the world is, as opposed to the way that people who teach you in university or in major media would like you to believe it is. Don't just buy the book. In fact, you don't have to buy it. It's at every library. Just read it. And then read a second book called The Intelligent Investor by Ben Graham. This is the best investment book ever written relative to the effort required to read it, which is low.
Do your own due diligence so that when you create an opinion, it is educated and not just based on hopium. Hopium is not a plan, right? Oh, look at it. It's going up. It must be worth it. Well, no, you really need to understand the true value of any asset or any instrument, because that, my friend, is the only way for you to truly know if something is undervalued, fairly valued, or overvalued. Therefore, do I want to buy it? Do I want to hold it? Do I want to liquidate it? And you need to learn how to look at the true trend of the market, not what Wall Street wants you to look at, not what the government or the central bankers want you to look at. Look at what they are doing for themselves. Because what they're doing for themselves is accumulating more gold than they ever have historically. And who knows more about what they're doing with all this stuff than they do? They know that we're at the end of the system. They want to retain their independence. They want to retain their freedom of choices. And that's what we want too, right? Food, water, energy, security, barterability, wealth preservation, community, and shelter. Get it done.
If you made money on cryptos, congratulations, that's great. You can do that in other areas. Why put all your eggs in one basket? And buying Ripple as well as Dogecoin or what, that's not diversification. Not like I'm talking about. There's still, speculative cryptos. So have a completely different basket. And, what if something happens and you're wrong about your thesis? Well, then this other thing can do well despite that. So I think if you've gotten the bug, if you've made some money, if you want to be a speculator, a successful one, not just somebody who got lucky following the herd at a time that it happened to work out, but one who consistently makes money over time, then you should diversify and look at what else has the wind in its sails. What other trends are investable now? And for the reasons that we started this conversation with, I do think commodities are a mega trend that will have, with careful selection, many money-making opportunities for years and years to come. So I do think people should look at that. And the other thing I might add, and again, anybody watching this already maybe doesn't need to hear this, but if you're going to share this with your friends, investing isn't something for rich old guys to do. It's not something that you have to have, decades of experience before you even think about. Okay, if you go into it young and naive, you'll make some mistakes. But that's education worth paying for. That aside, you really want to wait 40 years to take advantage of what could be life-altering capital gains? No, and you don't have to. And even more, if you're 19, got no kids, no responsibility, and you put all of your beer and pizza money into some stock and it goes to zero, you lost it all. Guess what? It's no big deal. You dust yourself up, and just try again. So there's very little downside to a younger person to give this a go. The very least you get, I think, is a very valuable education. And the upside is potentially huge. It's, you know, if you're feeling FOMO or you didn't make any money on cryptos and all your buddies did, I'm not saying there's no more money to be made there, but that was then. Today is now. I think you should look at other trends, such as what you and I are discussing, Vladislav.
You know, I think unfortunately the younger generation has been deeply disadvantaged by the experience that they've seen for the past several years. As I articulated, I think the rise in valuations of the stock market, and to a lesser extent, the rise in valuations of home prices, has created conditions under which they think that the world is effectively running away from them very quickly, right? They feel incapable of effectively getting themselves on that ladder. I don't actually think that's true. I just want to emphasize this. And so there's an element of hope associated with it that simply says, as long as you as an individual remain productive and innovative in the approaches and solutions that you bring to problems, the world will be the path to your door for a better mousetrap. What I strongly encourage young people to remember is that there is actually a path. Their parents followed it. My children have been directed to follow it. And as a result, they're trying to build wealth and value slowly. The most important part of that is building their human capital, gaining experience in relevant jobs, gaining experience in relevant education. I am a very strong critic of the US educational system, and a little bit less so of Europe, although I think in both regions we have focused education on more of a holistic life experience as compared to actually obtaining usable skills. My children largely pursued vocational educations. While that doesn't sound, they won't sound vocational. I mean, my children went to business school and studied finance, or my youngest son is going into the US military as a naval officer. Those are areas in which you build human capital as compared to necessarily gaining, you know, perspective on whether or not underwater basket weaving should be best done with, you know, actual wicker, or whether you should use a petroleum-based substitute, right? Learning how to weave baskets underwater is not a useful skill, nor is particularly studying the history of a particular race or culture, or learning about art history or music history. Those are not particularly saleable skills. And as a result, if you pursue those, you should expect to have a deteriorated expectation for your life ahead. We've robbed young people of many of the signals of that. And as a result, they tend to underinvest in the human capital while simultaneously looking with despair at the material goods that they want to acquire and saying, there's no way for me to get this other than the big scoring gambling. And gambling in its explicit form, whether that's gambling on cricket matches or football in the European sense or football in the American sense, is not a path to wealth. It's a path to ruin, path to dependence, it's a path to loss. And yes, there will be individuals who do extraordinarily well, and the vast majority of people are going to lose. The lottery has a similar characteristic, as do meme stocks and crypto tokens, et cetera. These are all things that have been sold to people as, well, it's a, you know, low probability that you'll get rich, but it doesn't require that much for you to get a spot in the game. You're basically throwing your money away on those, and the cumulative result is likely to end up with people being far worse off. As much as I'm a critic of investing in the stock market, as much as I'm a critic of investing in startup businesses, et cetera, I really strongly encourage people to put themselves on a path to saving and building wealth slowly and focusing on that human capital side in your 20s that positions you to harvest that crop in your 30s, 40s, and 50s.
There are no boats. There's this feeling, oh, this boat, and they're going to sail without me. Everything's a ferry. You sell something, something else will come in that'll look attractive that you'll get on board and go with it all. And if I may, and I'm noticing this now in a lot of metals players, they're using emotion to make their decision making. They don't have a plan. And I can just tell you, I spent 13 years working with a National Football League team here, and I was around the coaches the whole season. And one thing I learned is they spend their almost entire time, once the season starts, planning. So when the game is over and the players go home that Sunday night, they're already going in the office starting to work out the plan for the team they play next week. And they have a written plan by the time that Saturday meeting comes, when the coach speaks to the team and then the defense and the offense, they have a written plan on how they plan on going into the game. And if it isn't working in the first half, they rewrite that plan and go out in the second half in another way. Right now, I'm finding too many speculators without any plan. Everything is being traded. They're looking at gold, they're mining shares, the stock market, whatever, without a formal plan and targets and ready to act. And I know hope is a wonderful spiritual strategy, but it's the absolute worst investment strategy. And I hear this sometimes. I only hope it goes back up so I can sell. No. What is going to drive it to go back up? And if you're not prepared to buy it at this point, who do you expect to buy it to drive it up so you can hope and get your money back? So, written plan, sticking to that plan is going to be critical here, especially since if you think the markets have been volatile now, I think they're only going to become more volatile. You know, we're seeing this rise, we're seeing the VIX go lower and lower. This is just screaming that we're in for a huge, huge move. And usually that move is opposite of what it has been doing. That's why I'm so willing to and have made bets to the downside, because as much as the stock market has shot up dramatically, it appears it's vulnerable now to a shock to the downside.
The same advice my father gave me 35 years ago, pay yourself first, and every 2 weeks you get paid. I bought gold and silver. That was the only thing he asked of me when we started this company in 1990. Buy something every 2 weeks, an ounce of silver, whatever you want, something, some metal. So I don't look at gold and silver as an investment. To me, it's my wealth. I've bought it every 2 weeks for almost 36 years. February will be 36 years. Never missed a 2 week period. Let the laws of compounding work for you instead of against you. Most people go in deeply into debt and think that's the American rite of passage. It's not the case. And I think if you let the laws of compounding of time and effort work in your favor and interest, but in this case, for me, the non-interest bearing assets still outperform those that were interest bearing. You pay yourself first and you prioritize your future self, because procrastination is built into our DNA, I guess. And I'll do it tomorrow, but tomorrow comes faster than you think. You know, I'm 55 years old, and it seems like yesterday I started this company with my dad in a one-room office the size of a closet before the internet. And just like that, I got 3 kids. My youngest is a freshman in college. And I remember the day they were born. Well, how did that happen so fast? Because life is like a roll of toilet paper. And when you're young, you don't notice it spinning. But as you get older, it starts to spin faster, and you start to actually notice the end of the roll is there. You never think about it when you're young. And so prioritizing yourself first and saving every 2 weeks, no matter what, or every time you get paid, even if it's just a very nominal amount, it adds up over time. And you see people who are in great shape, they don't go to the gym, once a month or really hard the first month of the year. When I used to work out all the time, when I had more time, I remember there would be the month of January, the gym would be filled with people. By February, it was half that amount. The people, the resolutionists, decide to leave. Those that were methodical and habitual in paying their future self first in terms of their conditioning and their physique, or whatever you want to call it, well, they're the ones that were always there, and being habitual and getting into a routine. So for the young folks, I would say, pay yourself first. Let the laws of compounding be your friend instead of everyone else. It is their foe, and let the laws of time and effort and energy and interest work in your favor.
Knowledge is power, Vlad. And if you have a lot of knowledge, you really can't be taken advantage of. When you go into markets, it's a shark tank. Nobody's there for charitable purposes, right? Nobody has your best interests at heart. Everyone's trying to make a buck. At its core, it's pretty ugly, actually. It's driven 99.9% of the time by greed or fear, two emotions that you really don't need in your life. You don't have to be that way, as a young person who wants to grow your wealth. You don't have to be driven by those ugly emotions. And I would say, again, learn the basics of accounting, learn to read financial statements. If something, in my opinion, has the word crypto in it, which means secret, I would just stay away. I like transparency personally. I think financial markets should be predicated on transparency. If you cannot understand the value of what you're getting for what you're paying, move on. Like if you start reading the financial statements of a company, or you start listening to a quarterly report and you just don't know what they're talking about, it's not because you're dumb. It's not because you're not a good business person. It's because they don't want you to understand. And move on. You're going to probably succeed based on all the things you say no to. So stay away from the really complicated ones, the opaque ones, the ones where the waters are muddied, the ones where there's a lot of catchy and exciting keywords in it. Like in the name, it could be in the name of the company, it could be in the way the CEO is talking about it on a conference call. If it's all about selling the issue with great confidence, just remember that the word con man comes from confidence man. So if you're listening to the principles of the company or the whatever, it's a lot of confidence building about how great their company is. They have to sell it hard. I would move on. Great companies don't need to be sold all the time. So I would really encourage people to look to the great investment thinkers in history. Go all the way back to Aesop's fables, frankly. Start there. That will tell you something about human nature. And then I would, jump forward a couple thousand years to the work of Benjamin Graham in modern markets. And he was the dean of Wall Street, the mentor to Warren Buffett. He has two seminal works, The Intelligent Investor and Security Analysis. Then I'd move on to the essays of Warren Buffett. And, all this reading could be done in like a week, maybe 2 weeks. It's okay to sit on your cash that long. You're not going to miss any great opportunities while you're reading and getting up to speed. And if those things seem to make sense to you, I would just stay away from the crazes.
This is a question that's near and dear to my heart because my oldest son is turning 13 tomorrow. So and I've got 4 kids. And I want to instill like timeless wisdom in them. And one of the things I try and teach my kids is like, especially when you're early on, when you don't have a lot of assets, when you're young, that applies to most young people, your savings rate is much more important than your rate of return. So when you're young, you typically don't have much money. So whether you make a 10% annual return or 15% or 20%, it's not that big a deal on a small dollar amount. So the most important thing when you're young is creating that margin between your income and what you spend and your savings rate, how much you can invest. So if you're young and you can save and invest 25% of your gross income, it's hard to go wrong. I mean, if you're investing 25%, it's hard to go wrong. You would have to be a horrible, horrible investor to have a 25% savings rate in your 20s and not end up, in a really good spot down the road. So I'd focus on savings rate. As you begin to build your net worth, that's where strategy is more important than the savings rate. And as you begin to build some assets, that's where like I just said, strategy is more important. But simplicity is I think simplicity outperforms complexity over time. Is what I was trying to say. Simplicity outperforms complexity over time. So don't think just because you build some assets now you need to get overly complex. Keep things simple. So
Long research shows over the past 40 plus years that about 20% of your portfolio in gold is the sweet spot between risk and reward. So you do want to have exposure to gold. I encourage you, if you're a young person, to just buy an ounce of gold or go to a coin shop and put a coin in your hand and feel how hefty it is. One tiny little ounce of gold and you'll feel how hefty it is. And I think that signals to a lot of people, hey, this is real. This is real money, and it is historically. So you want to have exposure to gold. And then if you want to get into mining stocks, it does require some education. That is why I wrote the book. I'm not trying to promote it, but I got so many questions about why'd you pick this stock? Why'd you pick that one that I had to write a book on it, and it was about 2.5 years. It went through multiple drafts. We hired an editor. It was a lot of work, but it's not a long read, and I tried to make it entertaining. In fact, you can read the sample chapter, a free sample chapter on the website, on the book tab.
Start early, start now, and start with a set percentage. As far as what to invest it in, I would say focus on what really interests you. For me, when I was younger, I started with real estate, and that has paid off really well because, now I basically just collect rent, and the properties are paid off. I don't have to, do anything for it. It just, I just get a check every month in the mail. So that's pretty cool. Another one I would say is start with hard assets, real money. So precious metals are a great place to start, and you guys know Vlad is really into that, so that's a good mentor there. And I would also say look into, after you've kind of explored those, and after you have a set percentage of your net worth or of your monthly income that you're setting aside, I would look into where you live and what are some tax advantaged accounts or investments that you could make where you have to pay your government as little as humanly possible. So, for example, in the United States, we have what's called a Roth IRA, and we are taxed up front on the money that we put into that Roth IRA. But then after that, everything that we make out of that account is ours, and we don't have to pay the government. So that makes it a really nice account to take some high risk plays in stocks that could double, and find out what that is for your country where you are.
Say I've been with lots of successful people. A lot of my students are very successful, by the way, huge companies, and they've made billions. Really seriously, University of Chicago students of mine and USC students of mine. Some have been very successful. Some have been massive failures. Okay, some have been failures too. Some of that result comes from contingencies, just plain luck that I've seen. Just someone is at the right place at the right time and make success. Someone's at the wrong place at the wrong time and gets killed by a car. I've seen there are lots and lots of contingencies that you can't take care of. But when I look at the differences on balance, everything boils down to incentives. Everything boils down to incentives. People respond to incentives. They like doing things that are attractive, and they dislike doing things that are unattractive. And when you look at this world in government policies, which is what I do, is I look at how the incentive structures are put out there, why anyone who's starting out in life, who's not rich, why they would live in California is beyond me, the highest tax state in the nation. He moved to Tennessee just like I did. I moved from Southern California to Tennessee because of taxes. Working is a lot more fun with lower taxes. Understand the incentive structures and go to the places, do the policies where the incentives are best, and avoid the places where incentives are the worst. And that is just a very, very simple thing. And, people can change the volume of their income. They can change the timing of their income. They can change the composition of their income. And they can change the location of their income. They can do all of that. Look at the incentives and look at it logically with a green eye shade and make very careful decisions. Don't say, well, I like the mountains. No, you're in a world of economics and you've got to follow economic incentives. I left California, which I love, love, love California, because it taxes people who work and it pays people who don't work. And Tennessee is the reverse. And it's the best decision I've made. Once I passed the 3 years statute of limitations, I can now go back to California and enjoy it all I want. And I don't have to pay the damn taxes.
But when you're 27, 28, 30, and you don't have a mortgage and kids and tuition, you can take some risk. And I was very lucky to take that risk at the right time. But even though I knew I was lucky, I also knew how to think, like that famous line in The Big Short, where am I going to get screwed? What could go wrong? Don't just look at the upside when you're taking risk right now. For example, if you're gonna speculate in the S&P right now and you're 27 and you're gonna chase AI, be commonsensical. I got into the bubble of the .com bubble at the beginning, not the end. In other words, in the late 90s, not 2000 or 2001 when it was already tipping. So if you're going to take risk in this market, still do it intelligently. Be aware of the risk and not just the return. That's my first advice. I would not chase an AI top. I would get an AI bottom. You could argue that's still at the bottom. That's up to you. I knew the .com bubble was a bubble, but I got into it at a bottom, not at a top. Because if you were in That same investment you made in 97 or 98, which could make you overnight millionaire, would break your heart if you bought it in April of 2000. In other words, you've got to look at the downside, not just the upside. Where are you in the cycle with AI? Where are you in the cycle with crypto? I won't tell you because I have my own bias. Do your own homework, and as excited as you are, make sure you think you're getting in early and not at the end. I think some of these opportunities are at an end, not a beginning. Again, that's a personal bias from my own experience. The other advice I would give, especially if you're younger, and I think the real opportunity isn't just chasing NVIDIA. I wouldn't chase it now. If you are chasing NVIDIA or the Mag 7 or some AI stock du jour, please take the time to look at its net income margins. Look at its net income margins. As long as they're going up over 52-week averages, as long as they're holding, that's fine. Even if they're flatlining, that's fine. If you start to see net income margins dip and then stay negative, that's when you need to get out. Don't get caught in the Nikkei of 89 or the dot-com bubble of 2001 at the end. Look at the signals on the net income margin. Those are very important. Look at the risk before you look at the reward. Those are my two pieces of advice. My third piece of advice, especially if you're younger, is even easier, is just wait for a bottom. That's the hardest thing to do. It's really hard to do when everyone you're hanging out with for drinks on Friday is giving you the story of their return and looking at their iPhone and bragging about stock X or crypto Y or meme coin Z, and they look brilliant. They're just lucky, like I was with the IPO. If you're really smart and you're young and you're patient, you're doing your homework in some of these stocks or some of these opportunities, certainly if you're looking at the indexes like the S&P or the NASDAQ, I would just wait for a mean reversion. You won't catch the bottom exactly. You won't even catch the top exactly, but you'll know what it looks like when you see it. In other words, if you're 28 now and it takes you 2 years till you're 30 to get the S&P at 70% off, that's a great investment. That's a really good investment. It's very hard to do, especially when the world tells you the markets are only going to go up, the Fed has your back, mean reversion doesn't exist. It's a different world. This time is different. It's not. When you're 75 and you're at a top, I would sell. If you're 25, you can wait for this market to crash because you have nothing to lose. And then you can buy at or near a bottom. And then you have a chance to make a huge fortune over 10 or 15 years safely.
So the first question is like, there's no diet that's good for everybody, right? You have to come up with your own risk tolerance, think about your available capital, think about your time horizon. How long are you willing to park cash in an asset that is not liquid and leave it there because you believe in the future it'll appreciate and be worth more? But how long can you withstand that? Is that 1 year? Is that 1 month? Is it 6 years? Like what is it? You should think about that. So time horizon is very, very important. And within that, you should ask the question, but this will help answer it. What kind of investor are you, right? And I see many, many people in the market who think that they're investors, but their activity shows me that they're traders. That's how they actually operate. And they're not really buying ownership in a company, which is what an investor does. They're just trading share prices, which is what a trader does. And they think they're going to be able to time the swings and get in and get outs and be smart and all of this. And I think most people have to start there to realize that that's a almost impossible game to win over the long term. But in my experience, most investors do have to learn that the hard way. So get through that. And then afterwards, think about your long-term strategy. And for me, it's like building a house, building a building, building a business. You need to start with a great foundation, right? And so because of where I sit in the world, I'm heavily exposed to the precious metals in the mining sector. That's reflected in my portfolio. So, don't ask me about crypto. I have, exposure to Bitcoin and really that's it. And we can talk about that, but I qualify that asset a little bit differently than maybe most people do. But it's more of a bet on demographics for me, actually. We can talk about that. But from a portfolio standpoint, you want to start with the foundation pieces, the bedrock pieces. And these are the pieces that don't necessarily achieve capital gains, but they do retain your purchasing power. And so I'd start with, in my case, it's physical gold, it's real estate, and it's cash or cash equivalents. So there's a sort of a combination of retaining your purchasing power and liquidity, when I need it, right? And then building on top of that, always start in any industry and in mining with the best names in the business. Always start there. And so if you're looking at uranium, go to Cameco. If you're looking at gold, go to Agnico, and look at the best performing cash flow generating, dividend paying. If you're looking at oil, go to Exxon. That's where you should start always in a new industry, because that'll just give you a bit of an understanding of how industry trends function, how price action works, what these companies are paying attention to, and gives you a bit of a foothold in the sector that will perform, generally speaking, a bit better in periods of volatility. But always start from the top and then work your way down. And so once you've got your bedrock of sort of boring hedge assets like gold, real estate, or cash and cash equivalents, then you get into some very high performing equities like the Agnicos, like the Newmonts, like the Wheatons and the Francos. And then begin thinking about speculation, right? If you're willing to go down that path. But for me, it's like about 70% of my portfolio is investments. And these are, when I say investments versus speculations, if your audience is familiar with the mining equity sector, investments are companies that generate cash. Just think about it that simply. Is it a real business? Does it generate income? Well, that's an investment. I can invest in that business. That's an Agnico Eagle. They generate tons of cash.
Education, of course, obviously that's it. I mean, you've been self-educated and, you've helped many others with your podcast to gain knowledge. And I would say, what I teach basically isn't, load up on gold and silver. It's a portion of your portfolio that's absolutely necessary in today's environment. The past, this environment's been around for quite some time. But I would not discourage anyone from doing, free enterprise stock investing. I mean, there's value stocks out there. There's always new ideas. And then save in real metals. So you put that $50 away every month in silver, for example. And then if you want to invest after you've gotten a certain level of money and $1,000 or whatever, you start with your $1,000 and you got to apply the principles. You don't buy $1,000 worth of one stock. Many people do that, but you diversify. I'd say 5 or 6 is really all you need. I'm a big proponent of William O'Neill. How to Make Money in Stocks is a great book to start with. That's his first book. There's many since then. And he talks about what really moves the stock market and how to value a company. And so I would say, don't be afraid of the stock market. You don't have to, go into gold and silver only. Make that part of the process, but not the entire part. But you don't want to keep your money in a bank over the next 5 or 10 years. You want to keep it in your own private bank in real metal, or real money, I should say, which is metal. And then, as I said, you can move into, the general stock market. I mean, most people don't even have the idea of a business opportunity in the stock market. I'm buying a stock. Well, that's true. You're buying a stock, but really you're trying to buy a company. And if you're going to buy a company, you want a company that's going to make a profit. And you want to buy a company that's going to make a profit with a new idea that the market hasn't valued correctly yet. That's kind of where you want to start, especially when you're young, because you have the ability, if you goon it, make a few mistakes, you're still young enough to overcome them. And if you lose discipline, then you can do it, because you don't want to get married to anyone's story, no matter how good the story is. Discipline is destiny. There's a book titled that. And that's having discipline in basically all your affairs, but especially when it comes to money, because many people invest on an emotional level, not on a logical level.
I mean, when you're starting out, your objective is to get a good job, to impress people, to work hard, to show up, to be ethical, to be honest, and to invest in your own skills. It sounds cliche, but it works. If you wake up, show up, make the number go up every day, there are no tricks. The trick is to be better. The trick is to outwork your competition. The trick is to outskill your competition. When you're young, you have lots more time to bounce back from failures and frauds and misses. And you're learning things. But I think, as we think about educating our children and setting them up for success in life, learning how to compound your own capital by developing your own skills, and not the types of skills that you'll get from a traditional education necessarily, but things like how private markets work, contracts. A contract's only as good as you're willing to sue to enforce it. There's all manner of little life lessons in the entrepreneurship side of things that I think are not taught in traditional or even MBA type programs. and that can only be taught by experience. But the biggest investment class is not crypto, it's not commodities, it's not stocks, it's not gold. It's you and your individual skill set, your ability to earn, perhaps in a job in the beginning, and then you save up enough capital that you can compound your capital yourself. And then the other thing I would say to young people is you have to master your calendar. The biggest life hack that Team Doomberg uses is we optimize what we call our get to have to ratio. So divide your daily and weekly calendar into things that you get to do and things that you have to do, and outsource all the have tos and focus on creating wealth doing get to do activities, and you'll be well on your way. That's probably non-traditional advice, but that's certainly the advice that we give our children.
Well, I would give them the advice that I wish I had when I first went into the stock market. And that is understand that what drives stock values is the availability of credit to drive them. So if banks are going to lend money to people to buy stocks, which is what they've been doing, and this is evident, if you like, it, particularly in the level of margin debt, which is 1.1 trillion. It's over 1.1 trillion now. That was at the end of September. If you understand that, then watch the cycle of credit. That is the way in which you will accumulate a fortune. Don't get beguiled by fashion. That's the important thing.
Yes, to buy something, you need to have money to do it. And if they're giving you money, that makes total sense.
If the banks aren't lending money to speculate, because this is the other side of it, what happens is that once the credit bubble pops, the banks are going to want their money back. They're going to say, come on. And you'll find that they will be selling stock as collateral, irrespective of anything, because they've got to ensure that they don't end up with bad debts. And, it's tough. You'll find that suddenly you'll bust very quickly, particularly if you're leveraged.
But you have to remember that it doesn't matter what industry it is, AI or mining, these are cyclical markets and money flows. You got to watch how the money flows. And, I'm a long-term investor. So, I take, I invest in management teams. So I generally don't so much worry about money flows because, it's not unusual for me to own a stock for 10 years. That may sound crazy for some of your young investors, but that's just the way I invest. But if, for those people that are trading on a much shorter term basis, they have to really pay attention to money flows. And, right now, in my opinion, and, time will prove me right or wrong, is that we're now seeing money flow out of the major markets. The S&P looks like it's topping. Now, that's, just my opinion. And the NASDAQ as well. Some of these AI stocks look like they're topping. So, I don't know for a fact, but it looks to me very similar to the 2000 and 2002 timeframe. And I remember the dot-com bubble quite well. When the NASDAQ topped, at 5,000 in March of 2000, and within 3 years, it was down 80%. I can't predict the NASDAQ down 80% in the next 3 years, but where did that money go? All that money flowed into real estate and metals and the mining sector. And that's why we had a 10-year bull market, from 2002 to 2012 in the mining sector, where people were making 1,000 times their 10 times their money, getting 1,000% on, and there was dozens and dozens and dozens of them that were doing that, and and I think that's the environment that we're getting back into. I think we're going to see a rollover of the major stocks. I'm bullish on AI, but that doesn't mean money's not going to flow out of AI. It doesn't really matter. Amazon stock went to $3 back in 2003. So, and I think it was up as high as $150 or something in 2000. I forget exactly what the numbers were, but I'm not that far off. So, and that's what I think is going to happen to the current major markets, and that money will find a home. And because all these big institutions, all these big hedge funds, they need to go where the money is being made. And the gold sector has proven to outperform the S&P year to date, and it's woken up a lot of people. And we're going to have corrections along the way, as we're seeing in the last day or two. And that's normal, that's healthy. But I still think we're in a bull market, and I think we're turning into a bear market into the major indexes. And that money is, I think, in my opinion, that's going to flow into the mining sector. So whether you're a long-term or short-term trader, I'm not saying put 100% of your money into the mining sector, despite 100% of my money being in the mining sector. But, that might be a little bit too risky for some. But for me, that's where my personal money's at.
Actually, my advice would be make your mistakes now. Because, the mistakes sear the lessons into you, and you want to make them on little money, not on big money. So if you're starting now, make your mistakes now. Now, having said that, I'm saying this laughingly, but this is actually very important. There's many ways to invest. There isn't a magic formula. And a lot depends, frankly, on your own personalities. And what's right for me may not be right for you, and what's right for you may not be right for the next guy. And you can only figure out where you're good and where you're strong by doing it. And that's why, you start small, you lose a little money here, lose a little money there. And the main important thing is, to be a good investor, you have to know yourself very, very well. And now it's hard when you're 20 years old, 22 years old, because actually you don't know yourself very well. But as you get to know yourself, what you want to do is try to recognize, obviously, where your strengths are and where your weaknesses are. And it's very hard to acknowledge weaknesses. It's, as we all have strong egos that want to hide our weaknesses from us. It's an obvious coping mechanism. But that's why I say, you make your mistakes young, you try to learn from them. And you try to learn, what situation are you going to thrive in and what situation are you not going to thrive in, so that you can always try to put yourself in the situations where you'll do well instead of situations where you'll do badly.
I'll give an advice that I find annoying, but it's standard: diversify. And at a young age, you're supposed to be overweight risk assets and not trade. If you're trading cryptos, good luck. It's okay to trade. It's fun. I'm trading from the trading pits, futures trading pits. It's usually leverage 20 to 1. But don't underestimate what cryptos are. Number one, I would say be very careful. Buying into that mantra that you're supposed to just be what they call stacking sats, in terms of very volatile risk assets that went up a lot. So the one lesson I'd say right now is I stick with the view that I think there's certain times to not be worried about being overweight risk assets. There's certain times to be underweight risk assets. Cryptos are the riskiest. And the way I like to point out, in 2009, there was one, Bitcoin. It's revolutionary. It's had a great run. Now there's 21 million. So the lessons of unlimited supply are typically not good for price. And there's only 4 precious metals. So I'm overweight and biased. My bias is I think the next big trade might be gold, still doing well, but passing some of that performance baton to treasury bonds. And the bottom line is there's just certain times not to be worried about trying to never chase a bull market. And when you're young, you buy and hold and dollar cost average in. And I just look at. So here's my outlook. I'll point out that in 2018, when Bitcoin was dropping, it was around 10,000. I said it's likely to drop to zero. It got close. It went to 3,000. Okay, so I got 70% of that trade. You can say it was wrong, but got most of it. I still think it could easily drop to zero. The whole crypto space could easily drop to zero. And one example I gave you is unlimited supply. And I'll give you this example: one cryptocurrency, number 8 on all the cryptocurrencies is Dogecoin. It's a joke. It's worth $40 billion. That can easily drop to zero in valuation and still be overvalued. So I think the whole place is looking for a purge. And I think what's going to happen is a lot of young people who the joke is, if you ask someone under 30 about gold, they don't really care. They call them boomerangs. Because they like cryptos, but they've had a great run. I think we're towards the end of that run.
Well, the first thing to do is to look. They should look themselves in the mirror, and they should ask themselves the basic question: what am I good at, and what do I have fun doing? That's the first thing they need to understand. What am I good at? For example, not everyone can be an entrepreneur. It takes a certain personality, and it takes a certain energy, motivation. It's not for everyone, and a lot of people shouldn't be entrepreneurs. They should be really strong employees of organizations that someone else is the entrepreneur of, because every entrepreneur needs really strong employees, really strong team to make their dreams come true. What I've been lucky enough to have is the vision as an entrepreneur to build things from nothing, but also a team of people that work with me who are just solid, smart, competent, people who just love to be part of a strong team. I couldn't do anything without those people. And we've together built big companies. We've had a lot of fun doing this. And so if you're an entrepreneur, great. And if you're not, then join a team, be part of the team, and every strong team member will be well valued in a successful company. Very well valued. If you're a strong financial person, become an accountant or become a business manager, finance manager. If you're an engineer brain, go and be an engineer. Everybody needs great engineers, or a geologist. So, or a human resources person, an administrator. They're all parts of the ecosystem of successful companies. Find that company that suits your interest. If you have a social conscience, join a company like a renewable energy company or a human resources company that supports your beliefs and how people should work together. If you're just a great engineer, you love making things, go and join a company that makes things. I happened when I was young to love working outdoors. I wanted a job that took me outside, and so it was either become a fisherman or a farmer or a forestry person or a geologist in a mining company, and that's what I ended up doing. And I just loved it. I loved every minute of it. I wouldn't do anything differently. I just had a wonderful life because I got into something that I loved doing, that I was good at, and I was lucky enough in that environment to succeed. I had all kinds of luck along the way. But for a young person today, ask yourself what you're good at. And then once you've done that, look for a group that you can kind of sell yourself to, that you can join. It could be a big company. You could be very happy in a big company. There's a lot of very contented people, and there's a lot of frustrated people that need smaller companies to be more flexible with. So try to find that area that you're good at.